Most retail investors in India tend to have a very large proportion of their equity portfolios invested in growth-oriented funds. If you're looking for a fund that can give you style diversification, or one that tends to fall less when the markets are in a correction mode, consider investing in a dividend yield fund. SBI Mutual Fund, the country's largest fund house, recently launched the new fund offer for its dividend yield fund. Rohit Shimpi, fund manager at SBI Mutual Fund, spoke to us about how this category works, the pros and cons of these funds, and more. Do watch this interview to learn more about this category. Good afternoon and welcome to our show. SBI Mutual Fund has just launched the dividend yield fund. And we thought this would be a good time to speak to you about this category and what it means for retail investors to invest in it. My first question is, what is a dividend yield fund and where does it invest?
Yeah, hi, thanks for having me. See, a dividend yield fund, basically, the very bare minimum SEBI definition is that greater than 65% of assets should be invested in dividend yielding stocks. Of course, when SBI is doing this NFO, for our fund, we thought that we should make it a little tighter. So, we've actually put in the, a framework that there would be a 50% higher dividend on aggregate of the fund as compared to the NSE 50 or the Nifty 50. So, we have that hard limit which we would look to maintain. In addition, see, dividend yielding, stocks, we find that they are actually across sectors, across market caps. So there's, quite a bit of universe available for the fund. In addition, there is, options to do maybe like a REIT or InvIT, the real estate assets, infrastructure assets, which are getting placed in these vehicles, offer pretty decent dividend yields. That's something which also potentially the fund can look at.
So 50% higher dividend yield than the Nifty 50. That is the
that's
basic criteria.
Yeah. So that's at the portfolio average, I must just clarify. That's not at an individual stock level.
So what is the nature of the stocks that are thrown up when you apply this filter? What kind of stocks get included in the portfolio?
Yeah, sure. So see, as you would expect, dividend-paying companies tend to, be a little more mature, a little more stable in their, life cycle of the company or the life cycle of its growth. And, of course, as a result, you will necessarily need to probably exclude startups or companies which are just very early and the very high capex type companies, which may not be able to pay a steady or a sustainable dividend. That kind of gets excluded. But what that does mean is, because these companies are more mature, the steadiness of the cash flows or the potential for even growth of those cash flows can be pretty decent. And in addition, so as you would appreciate, in terms of corporate governance, investor interaction with corporates, etc., there's quite a bit of focus on getting them to give clarity on their not just dividend payouts, I would say, but broader capital allocation thought process of how to return cash to shareholders, whether they would look at buybacks or look at regular dividends. And investors have been engaging with corporates on that regard. So I think the broader corporate environment is shaping up quite nicely for, say, a strategy like this. And just in terms of what you mentioned, the kind of companies, etc., we're able to that. What those companies do really is that they, because they're more mature, there is some defensive, I would say, characteristic to those stocks that leads to some downside protection. Though I must caveat, it's an equity product or equity securities end of the day, so there is naturally risk associated, but it's a little lower than what one would look at with a generalized equity strategy. There's some lower risk associated with a strategy like this.
So essentially, you get more mature companies that can pay out dividends regularly. That leads me to my next question. What are some of the advantages for a retail investor of investing in dividend yield fund? You said there could be some downside protection. Could you elaborate more on this point?
Yeah, sure. And see, this is something which we ourselves was a bit skeptical, right? Because as you would appreciate, dividend yield is a small category at this point in India. And we when we realized that we had this product gap after the SEBI classification of categorization of schemes, we were wondering for quite some time whether to go ahead with a product like this. And the work that we did looking at global funds in the category, the equity income category, as it's known widely, looking at the local peers and looking at the Nifty Dividend Index, which has also now been around for 15 years. That kind of showed us that these funds themselves tend to have slightly lower risk characteristics than the overall market, whether you look at mid caps, small caps, large caps. And when we looked at the downside that was there in previous episodes of market volatility, whether it be 2008, 2009, or the COVID correction, or any significant market correction over the previous 15 years, we found in actually 4 out of 5 instances that this strategy outperformed during the fall. That was one aspect which attracted us to looking deeper into the product. And the second one really was the return side. It seemed like when we looked at the active dividend yield funds in India versus, say, the flexi cap category, broadly returns were similar over longer periods of time, even while this lower volatility was observed in the dividend yield active funds. And in the on the index side, that was even more interesting. That the dividend index actually beat the NSE 500 over the very long period of time since its inception, and that too while giving a lower volatility or some downside protection. So, in a nutshell, it seems like this is a product where you have, it's for slightly conservative investors, probably, maybe that's excluding those high growth type of stocks or minimizing them, underweighting them. But because it's able to give some downside protection as a result of having more mature companies that are generating cash and paying it out, and secondly, giving a decent or a comparative capital appreciation too, that seems to be the focus of the strategy, and that's something which certain type of retail investor or investors who are exposed to very different factors in their portfolio, like say for example only growth, or they could benefit from either diversification, or maybe even for first time investors looking to dabble into equities, this could be a slightly lower risk type product to look at.
So essentially, a retail investor gets a product that could potentially give you returns at par with flexi cap funds with better downside protection.
Yeah, that's what. So honestly, the year to year becomes a bit challenging, as you would expect in equities, any category, any active product or any passive product versus broader markets. But over longer periods, you're right. That's what at least the past results seem to suggest. And much of the literature that we've read globally also about how this category is positioned is kind of fits like that.
And as you said, there can be years when this category tends to underperform. Like in the recent past, it did very well in 2021 and 2020, but it underperformed in 2018 and 19. So in what circumstances does this category tend to underperform?
Right. So see, this strategy has some overlaps with the value strategy, simply because companies, other things being equal, a company with a higher dividend yield will probably have a lower PE ratio, other things being equal. So when value does well, this strategy does tend to, benefit. So as you would be aware, value did pretty poorly most of the previous decade, which was all about growth and quality doing well. And as we've in the post-COVID period, we've actually found from 2020 onwards that value as a style has been kind of inching its way back. I mean, jury's still out whether it's like a decade-long run or whether it's a shorter one. But at least initially, it started coming out pretty well. Just in terms, we looked at history, of course, and we tended to think of it more in terms of absolute volatility of the strategy rather than say relative volatility. So what I mean here is that Absolute is that you're looking at, say, downside deviation versus the market. You're looking at, say, just volatility of the overall portfolio versus, say, that of the market. And we found those were more favorable. Of course, the point you're referring to is relative, relative volatility, which is more like a tracking error type concept where, so there what we actually found is that certain years, and of course you quoted some years, but we went back a lot more in our study on this topic. When we looked at, for example, 2013, that was a year where banks were heavily weighted in the dividend yield index then, and those underperformed pretty sharply as during the taper tantrum of 2013, right? So that's one episode where we saw that happening. The examples you quoted, the 2018, 19, those underperformances. So in 19, we realized it was due to financials being underweight, in the dividend yield index, and those actually bounced back, right? As probably the worst of the asset quality got priced in on bank stocks. So I think the broader lesson we got from looking at this exercise was that there are periods when these large sector deviations, and in some cases even major benchmark stock deviations, which the dividend index, Nifty dividend index, was taking versus the full index, simply due to the methodology of its construction. Probably nothing wrong with that. That's the formulaic way in which it works. But that leads to quite a few, these big, movements versus the index, which of course an active fund manager like us would want to be cognizant of, because we while we did do the product keeping more absolute volatility in mind, but we would also not want it to be too too violently different versus the index. So that's something which we would try to of course, I'm not saying that it's easy at all times. We would like to not have such wide dispersion in relative returns as well. Probably some amount of it may the investor and the fund managers would have to live with, simply because it's a different product which is trying to offer a different risk reward. So in maybe very fast rising markets, there are potentially some periods where high growth stocks do well. A strategy like this could underperform in some years like that. We've certainly seen it happen in the previous decade, a couple of years, and periods where you have large, say, drawdowns, etc. This strategy could outperform. Interestingly, even at times when there is capital appreciation to be had in equity markets, we found this strategy actually could do well in 1 or 2 years, simply depending on what kind of sectors are there. So, like years in which, for example, IT is doing well. IT is currently heavily overweighted in the Nifty dividend index. Years where that is where it might. But, net, what we are trying to create a risk reward where you are doing not just the work on absolute volatility, but also being aware of the full benchmark, and not wanting to really be so outsized on stocks or sectors as the Nifty index is, so as to manage some of those risks effectively.
So what kind of investor should enter into these funds? Is it targeted at a particular kind of investor, or can all investors have it in a diversified portfolio?
Right. So we do think that it is possible for many types of investors to be looking at this strategy favorably. So even say first-time investors who want a lower risk approach to equity investing could potentially look at this. Keep in mind the portfolio is going to be quite diversified. So of course you didn't maybe ask that, but there's been one pushback we've got a lot, that how much of the portfolio is going to be just oil and gas companies, for example, or is it going to be just power utilities, or even like a PSU theme, for example. And we don't think that it is going to be so overweighted in those spaces that one needs to really worry about a long-term return or anything like that. If anything, it's quite diversified. So keeping that in mind, it's something which a first-time investor could use. Globally, we've seen this finding its way into even, say, portfolios of retirees, for example, looking at again downside deviation and some upside capture, or just in general, even investors in the accumulation phase when they're in their 20s, 30s, 40s, maybe accumulating for, say, retirement or future financial goals. This is something which could find a place out there. For an investor already having exposure to, say, growth stocks through funds or directly, this is maybe some balancing to the portfolio. It gives you a different flavor of value besides some defensive kind of characteristics, just because of the type of companies which are underlying the portfolio.
Very true, because most investors in India tend to be predominantly into growth funds. So it would do them perhaps do their portfolios good to have some exposure to a value-oriented kind of a product. What should be the minimum investment horizon with which a retail investor should get into a product like this?
Sure. While we mentioned, of course, the better downside protection, the lower volatility, end of the day, I want to emphasize this is an equity product, right? And should be looked at as such. So in general, as a house, whenever one is looking at equity products, we talk about a period greater than 5 years, So I think that is really something which one should look at, which gives you the benefit of long-term compounding. And, as your time period extends, the risks that are there of the market falling, etc., those kind of get addressed relatively better over the longer period, as the real compounding in equities works over a 5-year period or greater.
Now, when retail investors hear the name dividend yield, they want to ask the question, can it serve the need of a person who wants regular cash flows? So should that kind of a person use this fund? Can he expect regular cash flows from an equity product like this?
Yeah, that's right. So, see dividends now, if an investor is going to directly own stocks which are paying dividends, as you're aware, the tax treatment is quite unfavorable of those dividend payouts, right? Essentially, the investor is paying tax at the marginal rate, which could be 35-36%, right, for many individuals. So that's not so tax efficient from an income point of view. At the same time, if an investor is to say take a dividend or the IDCW plan or distribution plan of a mutual fund equity oriented scheme, the tax treatment is pretty much the same. So that's not something which helps a lot. But I'll tell you how it can be structured to improve that post tax return. Is that, see, the mutual fund trust itself does not pay any tax at the fund level when the company is giving a dividend to the fund, right? Because the vehicle is purely passed through. Where the tax gets applicable is when the investor actually redeems her or his units, right? So we are able to kind of think of maybe like a systematic withdrawal plan is something that's been getting popular among investors and advisors, and there you get the benefit of the lower tax which is there under capital gains. So structuring a systematic withdrawal plan, I think, works well. And additionally, for a product like this, because a slightly higher percentage of the total return you would appreciate is targeted from the income that the underlying companies is generating, right? So as an example, in maybe a broader equity fund, just about, say, 10% of total return may be coming from the dividends, right? But in a product like this, potentially 20-25% of total return may be coming from the dividends or the income which the companies themselves are generating in the portfolio. So that is something which can be used by the investor to structure a systematic withdrawal plan that can be relatively much more tax efficient, while giving at the same time the potential for capital appreciation over the longer term. Of course, there is some capital withdrawal in this kind of an option, because the entire amount the dividends in the companies may not be enough to do the entire. Of course, that can be structured based on discussions with an investor's tax advisor or financial advisor, and might be better for post-tax returns for those seeking income from such a product.
I've finished with my questions. Would you like to add anything about the product or the category, or any message to retail investors?
Yeah, that's right. I think as I mentioned, we were ourselves skeptical, right, while looking at the product itself. We took maybe a couple of years to kind of get completely convinced. Maybe to summarize a couple of the points, what struck us was how large was the category globally, right? And we found individual funds which were in the not just billions of dollars, but tens of billions of dollars in size, particularly in the US and Europe. The work that we did showed us really that this is a much broader category than we thought. So when we ourselves stepped in, we were worried that this would have probably not enough of a universe to invest in. We were concerned that maybe there would be just a few sectors, the same which I mentioned earlier, the oil and gas, power utilities, maybe a theme like PSUs would be very dominant in such a portfolio. We were happy to actually not have those, to have those misconceptions dropped when we looked at the actual portfolios and the kind of composition, kind of returns that they were providing. The second misconception I think which many of us had was that there would be very little growth in such companies, right? So there, when we looked at how the best kind of structure to invest would be, we thought that a mix of companies that have just the optically high dividend yields, let's say 3, 4, 5, 6% plus dividend yields, though that dividend has to be sustainable, right? You don't want to invest in a company where the business is getting disrupted or there are corporate governance issue or something like that, which may render the dividend unsustainable. Maybe you're walking into a dividend trap in that case, where you would probably lose capital and over time the dividend itself would start falling. You want to avoid that kind of carefully. And the second type of companies where you get growth as well as a decent dividend yield is where you have let's call it a less than 3% dividend yield, but the dividends themselves are able to grow at maybe a CAGR of high single-digit percentage terms, or preferably double-digit percentage terms. So that's where you really get the capital appreciation while giving some fair income as well. So I think combination of these two and a broad enough universe to invest in, whether it's across sectors, whether it's across market caps. I think the exposure to the value style, though not exactly a value fund, there are some differences. But I think the combination of those makes it interesting. Of course, we are talking about it as an all-weather kind of product. It's something, but in the current environment where interest rates are high as well, investors have been slightly worried about equities in the near term because of a relatively high optical valuations at a time when interest rates are also high. Maybe so in the short term, this could give some kind of protection to those investors. And over the longer term, if you're invested for the long run, we do recommend over say 5-year periods. That could be something that will give you decent compounding as well.
Thank you so much. I have learned a lot about the dividend yield category. I'm sure our viewers will also benefit immensely from this interaction, and good luck with your NFO.
Thank you. Thank you for having us.
Bye-bye.